Hey, what's up? It's your boy Isaiah, aka KingReubs. In this video, I'm gonna show y'all about investment screeners and how I personally use them and what I look for. If you looked at the previous video where I talked about the market caps, the performances, and their different type of ratios and fundamentals and things like that. I'm gonna go over and basically show you what I do. Now, as I said before, I use Capital One Investing for the reason they don't have a minimum balance, meaning I can open one for free. I don't have to put money in them, money in it right away, and it's pretty good. Very good, useful tools in here. And whichever online broker you use to get to the investment screener, just go to research and you'll usually see something called Find Investments and go to investment screener. Now, personally, I don't usually buy stocks more than for $20 each, just because I'm cheap. I mean, there's no way around it. I'm cheap, so I usually pick large and medium cap. And basically, the basic purpose of investment screener is to gather as many stocks as you can at just to sift through all the stocks that you would want to look at and investigate in. Look through their financial records and things like that. This is basically to just compile a list. And the New York Stock Exchange. Matter of fact, I'm not even gonna limit anything. Price $0 and about 20. Options. I do options, but I'm gonna get into that a lot later. It wouldn't make any sense to get into it now. Performance. These I don't really, I pay attention to, but in a different way. Ratings. I'll talk about ratings. So there's different analysts, and they usually give stocks different rates. Morningstar is, I think, $200 to $250 a month. But they do all the work for you. They give out all the ratios, the PE ratios, EPS ratios, revenue, cash flow statements. They do all they have it all. You can either have it sent to you, or you can get the subscription online. Again, I think it's like $200 to $250 a year. These you do want to somewhat pay attention to and reference to see what the consensus is on the stock, because that's basically the way I see how stocks work. If the consensus is bad, nobody's really going to deal with it. I mean, you can invest in it, sure, but unless something changes about the stock or people who have a different opinion on it now or later on, it's not really going to help you. So you do want to somewhat reference the ratings. Fundamentals, as I showed before, the ratios and everything. You can set your own personal preferences on those. And I believe I gave out tips on my last video. and the rest of them, betas, revenue growth, and things like that. So when you do compile a list, or whenever you fill out, exactly what you're looking for, basically what you want to do is grab a few to compare. Say I can grab about 5. So here's another thing I didn't touch on that you want to pay attention to very, very, very closely to. If you can see here at the bottom, the percentage of institutional ownership. Pay attention to that. Think about it. If they don't own a part of the stock of the part of the company that they work for, they don't care. They're probably not going to care whether the stock does well or not. You know what I'm saying? They don't care. They're getting paid. They don't have any stake in it. So if the stock tanks, they're not losing any money. The company goes out of business, sure, but other than that, they're not going to, lose their jobs at the snap of a hat. So you do want to pay attention to make sure they have some kind of investment within their own company. It only makes sense. I'm not going to buy a car from a manufacturer who wouldn't drive it themselves, So this is crappy. But I'm going to show you basically how I go through this. And then I'll talk about how to go about creating a watch list. Now again, you're going to want to get a notebook and do this. It is very time consuming, to say the least. It took me 3 hours. I do it 3 hours at a time to go through all, an entire list of stocks that I chose and everything. But it just basically compares them. Now, one thing you do want to pay attention to, you see where it says 32-week range, and then today's range. that's 32-week range is a year, so you kind of want to look at it like this. The lowest it's been or was this year was $7.81. The highest was 17, so it's coming off that. It's not too far away from it, but it is coming off that. Here, still pulling away. It's not that much of a gap. Here, it's not that much of a gap. And here, it's not much of a gap, but it did gain some ground. The reason why I'm saying to look at how fast it either recovered from its loss is to show how well a company can bounce back. Some companies take a hit and take a minute to, get back up to at least, off their low and, in the middle between where they were before they took that hit, or at least to get back to that high from which they were. You want to make sure that if it is a long-term investment, that the company can recover quickly from a loss. Now again, the stock market does take dumps, and I mean in all industries. All industries could go down all in one day. That doesn't mean it's a bad stock. That's why you want to look at it. If every stock in the Dow is doing bad, you want to kind of look at it and see, if you have a stock that lost $2, you want to see, did anything else in this industry lose that bad or that much? And if it didn't, if all the other industries did bad as well, then it's not that company. The stock market is just having a bad day. But if that particular stock just took a dump and the rest of the stocks are doing a lot better, it might be something internally wrong with that stock and that company. So you wanna be careful with that. And again, percentages and ratios differ from other industries. The 3-month performance down 32%. It's underperforming the industry, which is not really bad, but something you want to take into consideration. Okay, so we do have one outperformer, but it's down basically 4% in the last 3 months. Utility companies, just, I call them static companies. They don't really go anywhere. They're good for money, they're good for dividends and things like that, but utility companies don't usually go up or down much. Price to earnings. This is what they're expecting to make by these dates. This is how much they're expecting their stock to jump by these dates. So, I mean, and this is where earnings come in. Earnings are quarterly, and a lot of investors pay attention to this. If you're a long-term investor, it doesn't really affect you. Not really. I mean, you get a boost here or there because you have people buying and selling. So you may get a little action, but it doesn't really last long because day traders jump in and out. But for long-term investors, you do want to look at the EPS ratio to see, where the stock is going and how further of a jump is going, whether it's going a couple of cents or a dollar or two. Dividends, again, if you're going for dividends, if you're going for growth and things like that, you want to get a stock with a good dividend. Make sure it pays a good dividend. So this is how much you would get yearly per stock. Per share, that's how much you're getting a year. So again, like I said before, I'll show you a little trick to buying a lot of shares and cutting down what's called the cost share to stocks, so that you can gain profit faster. Again, they have nice dividends, not too bad. Net profit, that's not too bad. This is just terrible, and they're ashamed themselves. But you can kind of see why their net profits aren't as good as the rest of them. As you can see, they have a lot of debt, and that's why I tell people to always look at the debt to equity ratio. They carry a lot of debt, and they're not even, this company right here is not even, they're screwed, I could tell you that, like, bad. This is terrible. They got 72, they carry a lot of debt, barely making any return on equity. Profit margin's not that great. As you can see here, 3.80% of the company is financed through debt. They have a lot of return on equity. Profit margin is very large. But this is just a quick overview. There's a lot more things you could look at doing a investment screener and comparing them to each other. I'll be making more videos here and there. I think this one's gonna be it for a while, until I put more money into my account. I took all the money I made out to start my clothing line, and I'm about to jump back in. But I just wanted to make videos so people always ask me, and I like helping, especially my brothers and sisters out there in the African American community that want to learn more about stocks. Again, if you like the video, subscribe. If you don't, I get it, I understand. But look out for more videos. I'll see y'all. Peace.